battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Wow, would you look at this? We're at episode 130. Hard to believe, rolling right up to 200. Unbelievable. October 4th. Fall is underway already. Here in the Midwest, we're set for our 2 weeks of fall as per usual, and then it's right to winter. So we got to enjoy it while we can. Before we jump into this week's show, bye baby, we're going to cover a couple of the big stories and articles that are coming out that I think are important for investors to be aware of, not to react to, but just to be aware of. Number one, Kevin McCarthy ousted as the House Speaker. In a historic vote, hardline conservatives joined Democrats to fell California Republican after just 9 months. The House removed Kevin McCarthy as Speaker after a small band of GOP dissidents moved to oust the Republican leader, and Democrats didn't come to his rescue. And I think this points to the Oliver Anthony point that I made last week, Richmond, north of Richmond, that people are sick and tired of stuff not getting done in D.C. And it's not the fact that we just like the Republicans or just like the Democrats or anything like that. We try to be neutral right down the middle, calling balls and strikes as we see things. But we are certainly fiscally conservative. We believe in smaller government, the rule of law and personal property rights, that the government should shrink in size so that businesses and individuals and entrepreneurs can increase in size. That is so critical to a healthy and vibrant economy. What people are frustrated about, and the reason why Kevin McCarthy was voted out, was simply because people are sick of nothing getting done, nothing positive happening for the American people. And it's going to come up on both sides of the aisle. You're seeing this on the Democratic side. You're seeing this on the Republican side, that people are sick and tired of the establishment. They are sick and tired of the uniparty that D.C. has become. And remember, Oliver Anthony wasn't writing that song, Richmond, north of Richmond, because of just Republicans or just Democrats. When they asked him, "Oh, it sounds like you're a Republican," he said, "No, I'm actually not. I'm right in the middle. I want the government out of the way." So you got to understand what's going on. This is an important time in American history, in my opinion, because it's actually an American renaissance. I think people are standing up against the nonsense that's gone in D.C. You've seen these politicians that have gotten so immensely rich beyond their wildest dreams, making less than $200,000 or just over $200,000 a year. How in the world are they worth 100, 150, or $200 million at the end of their life or career? Well, the answer is something must not be quite right there, unless they're just really good investors, which some of them are. They've done some insider trading and all the rest of it that has helped them grow their net worth. But the reality is, on both sides of the aisle, people are fed up. That's a good thing. That's a wonderful thing. We were a country born out of a revolution. We are a country born out of revolution. And I think what we need to have is the Democrats and Republicans on both sides of the aisle come together and stand up against tyranny. That is so critical. It's a good thing. I think it's coming down the pipe. All right, Sam Bankman-Fried, this is number 2, SBF, his courtroom problems here. Looks like he is shaven on his head. We can't see him. Cameras are not allowed in the courtroom. Looks like he is going to have some big problems. He is arguing that he did not direct people to do the wrong thing. Bad stuff just happened, I guess, on accident. Just to point out the fact that we have this massive shift between the past 3 years, between 2020, 2021, and now in 2023, that rising interest rates exposes a lot of the nonsense that's happened with certain stocks and certain sectors of the economy, that the real cash flowing businesses, the real companies that have actual business operating models, are finally back in favor. People are finally realizing, hey, company profits matter. We can't just buy unprofitable Yes, some growth, but unprofitable businesses forever, and hope it works out. And basically the crypto thing was the icing on the cake. It was the straw that broke the camel's back of everybody kind of panicking and realizing, hey, substance matters. That's how we've been investing for our clients all these years now. Sometimes we miss out. Once in a while, we missed out on maybe the crypto craze or GameStop or the meme stocks or whatever it might be. But in the end, investing favors fundamentals. If a company makes profit and it grows those profits over time, its stock price will go up. High interest rates expose that. Warren Buffett said it's not until the tide goes out that you find out who's swimming naked. When the short-term treasury rate goes from 0.25% to 5.5% within a year, okay, a lot of people find out they're swimming naked. And that's why you saw all these bank collapses in March. I think you're going to continue to see this with the regionals. The highest and the biggest banks with the best assets and best balance sheets will be fine. It's just these regionals, not all their fault, but a lot of it is their fault, managed risk improperly. It's not just regionals. Some of the big ones are going to have problems, but they're able to absorb it. Bank of America in particular has a ton of losses on its balance sheet. There's some at JP Morgan, not as much, but the bottom line is that these interest rates expose bad management. And what it should serve as a lesson for us, just on a micro level for financial planning purposes, is do not do what these companies did. Don't over leverage. Don't buy stuff you can't afford. Don't think that the good times will always last. But at the same time, don't think the bad times will always last. Prepare for a rainy day. Have an emergency savings, have some cash in the bank. Now you can get 5.5% on it. Okay. And then the secondary thing is, as an investor, use these corrections. Right now, we are in an 8% correction in the stock market. Use these corrections as a time to buy. Don't panic. Don't do what everybody else is doing. Run the opposite way. When people are panicking, you should be buying. And that's the point of this article. Buy baby, episode 130, that when times are tough, the tough get going. The tough people, the tough investors with the backbone, with the experience in the markets will be buying equities from people who are less patient, who do not have the spine to stand the correction. And they will make the most amount of their money. Most of their return will come during these corrections, even if they didn't know it right in the moment. So my point with this article this week and this show is one simple sentence, and that's stocks are cheap. They're not the cheapest they've ever been. So don't hear me wrong. They're not as cheap as they were during 2020 when we urged you to buy stocks. They're not even as cheap as they were in 2022 when we urged you to buy stocks. They're certainly not as cheap as they were coming out of the financial crisis, but they are cheaper relatively to the past 5 years on an average basis. They're a little bit more expensive than the past 10 years, but they are cheaper than they were at the beginning of this spring. So it's time to buy. And I can't guarantee that you're going to be up. Nobody can guarantee anything in the stock market. So this is not individual investment advice. You got to do this on a goals-based plan. But if you've got a time horizon of 5 years or more, I believe if you buy stocks today, you will be up 5 years from now. Okay, we're in an 8% correction. We've got an 18% upside, in my opinion, 18 to 20% upside over the next 12 to 18 months, placing the S&P's risk-return profile at one of the most attractive points it's been for 5 years. We have not had an environment like this other than COVID, other than last year in 2022 when stocks traded down, with such a nice risk-return profile. That the downside is there. It's always been there. There's always downside potential in the market. But when you go into stocks, you just got to ask yourself the question, what's the upside versus the downside? I think the upside now is worth owning. There's going to be a lot of temptation, there already has been, to sell out of stocks or to buy fixed income. And a lot of people are saying if rates stabilize or go down 1%, that fixed income would have a 14% upside. I don't doubt the math on that. I'm not questioning the numbers there. But what I am questioning is their belief that interest rates are going to go down and down to the magnitude of 1%. Now, we all know the Fed is going to break something at some point in time. They're going to break, in my opinion, small companies first, Small companies are already struggling. We're seeing this with our clients who own businesses. They used to finance their loans at 3.5% interest rates. Now that's up to 10%. That's a problem. That's going to be an issue. It's going to lead to layoffs. That's the easiest lever for companies to pull. I just did a post this morning, check it out, about the fact that we need to be very aware of the fact that small companies are going to struggle for a while. Be aware of that, okay? But I don't think it's time to rush into fixed income, because the secondary factor beyond just rates going up or down, remember that short-term basis, is quantitative tightening. The Fed shrinking its balance sheet. And so if it continues to do this program of quantitative tightening and selling bonds, we are going to continue to see rates go up. And the other thing is, if we avoid recession, which the Fed is desperately hoping for, they're hoping for two things. Don't forget this. The Fed is hoping that unemployment ticks up. They're hoping for doom and gloom. Okay, they're going to get it at some point, hoping that unemployment ticks up. And then secondarily, that we do get into a short-term kind of soft landing recession. If they do that, then they'll cut rates. I don't think it's guaranteed 100% for sure that we get into a recession. And I think one of the ways that we get out of a recession or avoid it completely is by spending more money on a potential war with Russia. We've given Ukraine $75 billion, and that's a proxy war. Ask anybody, that's a proxy war. Okay, if we get into a hot war with Russia, it is going to continue to stimulate the economy. I'm not rooting for this. I'm rooting against it. I hope we don't get to that point, but that's a reason why I think we could avoid recession and further see bond yields continue to rise. So just be careful there. Yes, fixed income is tempting. It looks really good on paper, but I think you could see more losses in the short run. Eventually it'll be a buy. Eventually it might make some sense, but I just think it's too early. All right. So stocks are the only place on earth where they go down, they go on sale, and everybody gets nervous and panics and runs for the hills. If this were Costco and Costco were running a 10% off sale, you would have people that start to get really interested in buying. Then if they run a 20% off special, like a 20% correction in the stock market, millions of people start buying. What about 50% off? They run a 50% deal at Costco. Forget about it. It's pandemonium. If the stock market's down 10, 20, or 50%, people get more and more nervous the further and further it goes down, and want less and less stocks at the ideal time to be buying. Don't be one of the people in the herd. Do not panic when stocks are down like they are today. Profits are expected to be strong. If you look at all the data for 2024 and 2025, yes, we could see a black swan event happen in the short term. It could trigger another short-term correction, but profits are going to do just fine. Here's an easy example, and none of this is investment advice. I'm not saying to go buy any of this stuff specifically. It's just informational. Apple is on a 12% off sale. Their stock is down 12% from all-time highs after doing $328 billion with a B in revenue, producing an $80 billion profit. Apple's profit alone is bigger than most of the revenue of a lot of major corporations. Amazon's in a 14% correction. Nvidia's in a 12% correction. JP Morgan down 17%. Microsoft in a 10% correction. You go down the list, utilities on a sector level are down over 20%. I think almost 30% now. Staples are down 14%. Real estate is down 30%. The financial sector is down 22%. And so remember, the stock market is a discounting mechanism. It looks not at the past, but into the future. And it says, what are profits going to be in a year, in 18 months, or 2 years? Usually it really prices things in 6 months in advance. And because of that, you do not want to panic. You do not want to sell. You want to do the opposite. You want to buy this stuff when it's cheap, because the narrative will eventually shift. The narrative will turn. And that's when you make most of your money. I'm not recommending you do this on an individual level. This is not individual investment advice, but you need to be on a plan. You need to be taking profit on things that have done well and putting that profit into things that are not doing as well. Okay, what did FactSet say? Well, FactSet, who does all the earnings insight research on the S&P 500 companies, says that stocks now today are cheaper than the 5-year average, and they're only 2.2% more expensive than the 10-year average. So you're telling me after 10 years of growth, after 10 years of profitability and 10 years of increases in the stock market, record all-time highs, the stock market's still only 2% more expensive today than it was 10 years ago. That's absolutely incredible. The top sectors FactSet points out are information technology, industrials, healthcare. Some of the bottom sectors would be energy, communication services, financials. So we like to look at the companies that are not doing quite as well, but we think are going to do well on a go-forward basis. I'm still a little cautious here on utilities. I think utilities could continue to suffer from the problems that long-term bonds are suffering from. It's not to say we're not going to buy them at some point. In fact, we're actively looking at it, just not ready to pull the trigger quite yet. But I like certain areas of IT. I like the Magnificent Seven. I like some of these big companies with big balance sheets, with strong earnings that are making 5.5% risk-free on their cash, that have operating leverage. I like some of the big banks where they're going to be beneficiaries of the issues with the banking sector. I'm not rooting for it, but that's the reality of being an investor. Energy, I like. I don't overdo it. I don't want to overweight energy right now, but I think it should have a place in the portfolio. Communication services. These are some of the Magnificent Seven companies. They're doing just fine. They're doing very well. There's going to be some consolidation, but I believe there's a buying opportunity on a lot of sectors. Not every sector is cheap. Not every area of the market is inexpensive, but some are prime for buying. What you find with all of this data analysis, all the stories out there, everything that's going on with fund flows, that's money going in funds, out of funds, you have to ask yourself, what are people doing rather than what are they just saying? Well, what are they saying? Companies are bearish. All of CEOs, if you read earnings, if you listen to earnings reports and calls, CEOs, management teams are not the most bearish they've ever been, but pretty darn close to it. Wall Street's bearish. Analysts are bearish. All of the top market strategists said that the world would come to an end in 2023. Some of them had to say, oops, we got it wrong, revise those estimates. And then they told people to buy stocks at all-time highs this summer when we said, watch out, be cautious. Investors are bearish, saying the doom and gloom is right around the corner. But the question is not, what are they just saying? What are they doing with their dollars? More money has never been on the sidelines than it is right now. And when you have more money on the sidelines than ever before, you have people bearish, you have people negative, you have them worried and nervous about the future. And by the way, I think we all understand the risks of the market right now. What happens is stocks continue to climb that wall of worry and make new highs. Stocks are a risk and a bubble when everybody's positive, everybody's optimistic, nobody's worried about the risk out there. They're a sell when that happens. It's the opposite when everything's bearish. When everybody's nervous and worried and everybody's aware of the risk and everybody thinks the world's coming to an end, that's a great time to come in and be bullish. So I would be bullish here. I think, again, not the best buying opportunity on record, but pretty darn close. It could be one of the best that we get for a while. By the way, September historically, and I don't buy much into this data, I don't read into it a whole lot, but historically, September can be a bad month for stocks. That's pretty typical. And the big question is not September or October, but really, what are we going to see with the rest of the year? Do we see a Christmas? Do we see a Santa Claus rally? By the way, I'll make the same promise this year that I made last year. Didn't get to do it last year, but if we get the Santa Claus rally, I will do the weekly show, the December Christmas special in a Santa suit, of course. I didn't get to do it last year, so I'm hoping we can do it this year instead. 08 and 09, let's go back to the last time stocks got really, really, really cheap, and I'm talking much cheaper even in the Corona crash. In the aftermath of 08 and 09 and the great financial crisis, nearly every sector, industry, and company were dirt cheap. The S&P traded for less than 9 times forward earnings in February of 2009. What did we do? We shouted from the housetops, buy stocks. Thank goodness most of our clients listened. They didn't sell at the lows. Then you had the Corona crash, not quite as cheap as 08 and 09, but in 2020, March and April and June, stocks presented a similar opportunity. The market traded for 11 times forward earnings. Again, not all-time cheap prices, not all-time lows, but pretty darn close to it. And what does investor sentiment do every single time? It's the same predictable pattern. Think about this. Investors feel exuberant at market highs. They see the stock market at record all-time highs. They see their neighbors making all this money, and they go, why am I not making all this money? I got to get in before it's too late. They buy at all-time highs. Eventually, enough people get in, the top becomes a bubble, and it bursts. Those same investors that chased the high, that didn't buy in at a low before, but rather got in at all-time highs, now sell at the lows, the worst possible time, a market trough. Then the market starts rebounding. It recovers some of its losses. Those same folks that bought in at the highs and panicked at the lows start believing the recovery is a dead cat bounce, meaning it's not going to last, and that they'll have another chance to get back in at lower prices. Usually they never do. And I'm not telling you this just from, this is like a nice chart to put up or a nice, thing to remember. This is reality. We've actually seen this happen almost every time with clients, that they try to get in at highs, they sell at lows, and without proper guidance, without a financial advisor, expose themselves to buying at the top and selling at the bottom. That's a great way to lose a bunch of money. Rather, what you want to do is buy low, sell high. Everybody knows that. It's so much easier said than done. And what it requires is fortitude, discipline, and bravery to turn off that TV remote. And I'd encourage you to do that. If you're still glued to CNBC or you're glued to Fox Business or whatever show you watch, take that remote, click off the TV, go out for a walk. You got a couple weeks here left in the Midwest to enjoy it. If you're in Texas or the South, some of our clients down there, you got all year to enjoy it. Get out of the house. Don't watch too much TV. It will make you panic. That's the point of the media, to get you to sell your stocks. Why do you think all the advertisers on Fox Business and CNBC are gold, silver companies, annuities, real estate, trying to sell you stuff that you would buy after panicking? It's just common sense. The media gets you to panic. The advertisers sell you stuff to panic into. And each and every time you are left holding the bag. Watch out for that stuff. I'm telling you, we could see a little bit more correction, a little bit more downside before the market goes back up. Now, the big difference between today and the corrections of 2020 and 2008 and 2009 is that right now, I said this before, not every sector, industry, and company are worth buying. We have been urging selectivity amongst high-quality companies that are consistently growing revenue and free cash flow over time. You have to be smart about what you're buying. Becoming a good investor means remembering stocks are a claim on real assets, not just a flying stock ticker across the screen on CNBC. Stocks, as Dr. Siegel always reminds us when he comes out and does a presentation, are a claim on real assets. You having Amazon, Apple, Microsoft, Google, ExxonMobil, Procter & Gamble, JP Morgan, whatever stocks you own in your portfolio, you don't just own them on paper. You literally have a claim on those companies' assets. And what the media has done is they've tried to convince investors that that's not true. They try and convince investors that they should be day traders, that only the rich get richer, that only people at the top and people with inside information know how to do this. The reality is the exact opposite. Our client base proves that. Our client base is full of people like you and I who have just held on for a long period of time, who have not sold their stocks, who have been patient, who have bought at the bottoms, who have rebalanced consistently and diligently over 10, 20, 30, 40 years and are now multi-millionaires. And by the way, most of them, if you saw them walking down the street or saw the house or car they lived in, their car they drove or whatever else, you would never guess in a million years that they had millions of dollars in the bank, but they do. This is something that you can get better at over time. You can become a good investor. It's all about behavior. Now, if you work with a financial advisor like us, you got to pay us. We charge an advisory fee, and it's usually all in about 1% or less on your assets. But the fact of the matter is that advisory fee will pay for itself over time by getting you to just stay on your plan, by getting you to avoid the massive landmines, the massive stepping on giant rakes and doing the things that would blow your plan up over time. So you got to work with somebody. And I always encourage you, get a good advisor, get a good tax person, get a good estate planner, get a good doctor. Make sure you have the professionals, the best minds surrounding you. There's a saying in the Bible that you should surround yourself with a multitude of wise counselors. And so you should really think about doing that. If you're not with an advisor, you're not working with a good team, whether it's tax, estate planning, whatever it is, get those people around you because they can help you avoid the mistakes that a lot of people make in the short term. Remember, companies are a claim on real assets. There's real cash, real operating IP, there's intellectual property, there's assets, revenue, there's all this wonderful stuff that's real claims on that business's profits. You do not want to sell that stuff when it's on sale. Buy some more when things go down. Wealth creation is somewhat simple. Entrepreneurs, when incentivized by the rule of law and personal property rights, what do? They innovate new solutions to old problems. Entrepreneurs are the lifeblood of this economy. Turns out that if you throw them in jail for speaking out against the empire or the regime, they stop innovating. Surprise, surprise. That's China. Oh, you say something that President Xi doesn't like? Next thing you go missing for 2, 3 months, 4 months, 5. Maybe we never hear from you again. And all the other entrepreneurs are looking at that and going, why would we ever create a business in China where it's just a matter of time before President Xi takes the business away from us? You wouldn't do it. You'd come to the United States. So all the top Chinese minds are here, all the top European, all the top Japanese, all the top Europeans, the Africans, the Latin Americans, people from all over the world have been chasing freedom, chasing the rule of law, personal property rights, all the stuff the United States offers to the world. Everybody is coming here. And yes, we've got our problems. Yes, we've got our issues. Yes, DC is kind of a mess sometimes, but we still are the shining city on the hill. We're still the land of the free and the home of the brave that I believe will continue powering growth forward for years and decades to come. Make no mistake, innovation is the lifeblood of capitalism. Capitalism is the lifeblood of freedom. Because of that, democracy and free speech are directly tied to free markets. Censorship, bureaucracy, and central planning, on the other hand, are the hallmarks of Marxism and communism. They always lead to economic collapse. I'd encourage you, think about one communist regime over time that's actually made it. You can't name one. One socialist country that's made it over time. You can't. It's never existed. It's capitalism, which has its problems, but has been the best form of government and economics that the world has ever seen. Why? Because capital alone, money, dollars, assets, and resources alone in a vacuum don't grow wealth. They don't create wealth. What creates wealth? Good ideas. Good ideas that I believe come from God, result in wealth creation, and over time lift people out of abject poverty. They reduce infant mortality. It's entrepreneurs that increase standards of living and deliver better medical outcomes to the rest of the world. It's entrepreneurs innovating, creating wealth over time that make this place a better world to live in. Become an investor over time by understanding deeply the way that companies operate, the way that entrepreneurs behave. I think one of the reasons why Shark Tank, the show on CNBC, has become so popular over the years is because people love a winning story, an inside seat to what goes on with entrepreneurship. They look at them, they go, I can do that. That's all entrepreneurship is. They look at a problem, they go, I can fix something. I can do better than that. They create a business. If that business thrives over time, they do a good job and the right thing for customers. And by the way, if you don't do the right thing for your customers over time, guess what happens? You go out of business. And nobody talks about that in capitalism. They point to the billionaires, the multi-millionaires, and the rich. They never think about all the people that have not made it, all the businesses that have gone under. Capitalism rewards success and it punishes failure. And so if entrepreneurs do the right thing for their customers, they'll build revenue over time. They'll hire more employees. They'll see a small portion of the profits. The rest of the economic value will go to their employees, to their customers. Things will get better over time. And so if you are thinking about how do we continue this economic engine that's been so successful in the U.S., you got to vote for smaller government. You got to get government out of the way of our individual lives. And it doesn't matter if you're Democrat, it doesn't matter if you're Republican. You got to vote for the entrepreneur, for small business to increase, and for the government, the authoritarian, tyrannical government, the Richmond to shrink, so that businesses can get back to what they're good at, which is innovation. Innovation reduces costs. It makes life better. It's all the stuff that we all want. And that's the driving force of the stock market. I think it's still intact. I'm still optimistic. I'm still bullish. Do not panic. Use this as a buying opportunity. Again, not the best buying opportunity on record, but it's certainly a good time to get stocks on the cheap. Thanks for being with us for episode 130. We'll see you next week for episode 131.